Yeah, I'm in Australia. Cool. Alrighty. So, hi guys, this is George from DoraHacks, and welcome to the online workshop series Release Your Inner Bull, proudly hosted by DoraHacks and Archway. Today's episode will be hosted by Xavier Meegan, Chief Investment Officer at Chorus One, and he is here to talk about pitching to investors, sharing some key insight into what they look for and how to make sure that you get noticed. At DoraHacks, we are happy to host this workshop with Archway to give the community some insight and know-hows into the Web3 space, touching on different topics. For a bit of an introduction, DoraHacks is proud to support Archway on their latest hackathon, which is currently underway on the DoraHacks.io platform. It is a great opportunity for developers to earn a share of the large prize pool, and hopefully today is helpful for all developers that are building on Archway. For anyone in the YouTube or Binance Live chat rooms, please feel free to ask questions in the chat box as we go, and I'll ask these to Javier later on. So without further ado, let's welcome Javier. Thanks for joining us today.
Yeah, thanks, George. Appreciate the Spanish pronunciation of my name. I'm Xavier from Chorus One. So welcome everyone to whoever is tuning into this. So yeah, I think this presentation will be quite conversational, and I also want to leave some questions for anyone to sort of drop any they might have, so it's not just one way the whole time. But yeah, I guess this presentation will be about specifically how you and your team can pitch investors. So Chorus One, for some background on myself and also some background on Chorus. So Xavier, as mentioned, I'm the Chief Investment Officer at Chorus One. So I've been at Chorus now for 2 years. We're an investor in Archway already, so work quite closely with their team. We're running nodes on about 40 plus proof of stake networks now. So yeah, a bunch of engineers running those. And then on the business side and the venture side, about a year ago, we announced a $30 million fund, which I'll get into in a bit, and actually compare sort of the way we invest versus some other investors as well, which can be very useful to sort of realize before you go out pitching. And yeah, now to the point, we mainly predominantly invest in Cosmos, but we also do a lot of work in Ethereum, Avalanche, Solana sometimes as well, etc. So yeah, without further ado, I'll get straight into the presentation and just give you an overview on what we'll be covering today. So yeah, today I'm just going to sort of touch upon 5 main points, and then I'll go into a bit of detail actually on each slide, and then you can ask questions if you have any as well. So yeah, the first point will be about researching an investor before pitching, which I think is really critical, and I'll explain more on that shortly. I'll also explain what excites me when I'm reading a pitch, which I hope can help you in your pitch as well. I'll also share some items that could be considered bonus points, which to really drive the point home and pique an investor's interest in your project, what you can do. I'll also talk a bit about negotiating terms with an investor that might be leading you around, and then finally finish on how you can stand out from the crowd, because at the end of the day, this space is highly competitive and not all projects succeed in fundraising. So I'll give you some tips on perhaps how your team can stand out when speaking to investors. So this is the first point, which I think is quite critical before even speaking about anything else, is to do your own research on an investor before pitching. So there's many reasons for this, and I think the main reason would be just because each fund is really different from the other and have different strategies and how they invest, different sizes of the fund, for example, different value adds as mentioned here as well. And maybe different sort of theses, is what you're building in line with their thesis. If you're building a centralized exchange and their thesis is about everything will be decentralized, then it's quite clear that they won't be interested and you'll be wasting your time when you're pitching them. So in particular, these 6 VCs I've got on the right here, I also wanted to chat a bit about the differences between VCs, which isn't always obvious. It's part of the game, and I'll talk about the game a fair bit during this presentation. But I think when you want to start fundraising, you need a strategy, a clear strategy before you go out and do it, because otherwise it can turn into a bit of a mess with organizing, working out who's interested. And at the end of the day, a lot of investment and also investors, the way they think, it's about momentum of the project and how hot your project can be, how interesting it is for these investors. Investors often talk to each other. So yeah, you want to make sure you have everything, all your ducks in a row before you go out and start pitching. So yeah, the first point here is on the vertical. So before you go out to a fund, do you know what vertical they're investing in? And are you pitching to the right fund on the right vertical? For example, in Archway, you might be building a DeFi project, but then you might reach out to an investor that only invests in infrastructure. Or not even that. Maybe the investor does actually invest in infrastructure as well as DeFi. However, you've got a call with someone in the fund that is the partner for infrastructure and not the partner for DeFi here. So at the end of the day, this goes back to actually like strategically working out where you want to play before you actually execute on strategy. And here it would be more sensible to work out, before the call, if you're speaking to the right person, first of all, and then also checking that this fund is actually investing in what you're building. So yeah, the second item here is the type of fund. So this can also range, which might be unfamiliar to you. And this is, again, not always clear and can be opaque, but different funds have different sorts of structures, let's say. So some of these funds might be closed-ended and some of these funds might be open-ended. So what does that mean? A closed-ended fund means that a fund raises capital at the very start, and then they'll distribute some returns and value back to investors that backed them in the first place in some given time frame, maybe in like 4 or 5 years' time. So there's a lockup that investors need to undergo before they receive any types of distributions back from the fund itself, because it's closed-ended. An open-ended fund is very different. So there are different investors. This is definitely something that you should check before you take on any investor capital. There's no right or wrong between closed-ended and open-ended, but it's worth knowing. So an open-ended fund means that investors can take out capital more freely, so they don't have to wait 4 or 5 years, and they can also inject capital at various points. Instead of all the capital being collected and confirmed at the start, you can sort of open-ended put capital in and also take capital out. It's not every day, but there's much more liquidity in sort of these types of funds, and this might mean that they require more liquidity on your project or your token, and that might be more interesting for them. Whereas like a closed-ended fund, if you lock up your token for 2 years or plus or whatever, they might be more prone to investing in something like that because they're not so much thinking about the liquidity of their own fund, but they're more thinking about like 5-10 years, these types of returns. So another critical thing to mention here on the type of fund, apart from the structure, is also on the fund itself and who's actually giving this fund capital. So you have various funds here again on the right. So us, for example, at Chorus One, we're on the bottom right, that logo there. So we do not have external investors. It's just we invest with the balance sheet we already have. So we are not answerable to any external investors. It's essentially just us. And yeah, we don't have to return, and distribute the returns back to investors. We can hold more than even a sort of a fund that has external investors, because going back to the structure, some of the time horizons of these funds, maybe it's like a 5-year fund, maybe it's like a 10-year fund. But at the end of the day, they always need to distribute back returns to investors at some point. So they're going to want to liquidate not everything, or potentially not everything all in one go, but at some point they will liquidate. Whereas someone like Chorus One, we can choose whether we liquidate in 2 years or 10 years or 20 years. It's very flexible. We're very fortunate we can do this off of our balance sheet, but it's just something interesting to consider. Whereas, like, for example, maybe another VC, like a placeholder here on the top left, or a CMTC, might take external investors, which is also totally fine. In fact, what that means is that they'll be able to probably raise more money because they're not so restricted to the capital they have on their balance sheet. And at the end of the day, all it means for you is that, maybe if you have different rounds, you have seed, Series A, etc., these are the types of funds that would probably be able to follow on because they have more capital. And again, here, going back to the structure, placeholder, for example, is a closed-ended fund. So they will be in it for the long term with a lot of capital potentially because they have outside investors. But it's just good to know what types of investors have different structures, and how maybe a variety of them in your type of round can also be something to consider. So the fund size as well is, again, here you can compare between all 6 of these. So, what is the size of the fund? So you might have like a placeholder or a faction here in this slide, which will probably be on the bigger end of fund size, which is again totally fine. And they're very lucky in that they've had, or not lucky, but they've done some good work and they've been very successful and they've been able to grow their funds and also raise more capital. So they have more flexibility on the ticket sizes, as in how much they allocate into different rounds. However, what's really important to know here is that they want to return their own funds. So if they raise X amount of money, they still want to return that money to make sure that they're not losing capital. So the way they invest might be that they require bigger allocations into rounds. So it's just something to bear in mind. If you're raising 3 million, I'm not saying that faction and placeholder won't do this because I don't know 100%, but it's good to check with an investor before you speak with them, like what is the minimum they would require to invest in you. If it's too high and you're not raising that much, then there might not be a point speaking with them yet, or maybe you can speak with them and then say maybe in the future. Or on the flip side, if you want to raise more money, then you need to be careful about the valuations that are then created for it to make sense to raise more money. Because if the valuations are too high, maybe it suits one VC, but it doesn't suit the rest of the VCs. And for example, here in terms of fund size, of course, one where I'm coming from, so we're a much smaller fund size. So if we see a valuation that's very high, we might not actually go into that because we don't deploy as much capital, so it might not make sense for us. But maybe there's a small round and there's not a lot that your team is trying to raise, and that's more interesting for us. So it's just about understanding the different sizes of funds and what they look at, what's interesting for them or not. Then finally here, we've got a value add. So each of these funds and any fund in general has a different value add that you should consider before going out to pitch and to raise. Because ideally you have funds with different value adds that can help you in as many areas as possible to make sure that your team is set up for as much success as possible and that you have a complete picture and you have all facets covered. If you have many of the same value add, you might be lacking in some other, which is like maybe research you lack in, or maybe like legal, or like with us at Chorus One, a value add for us would be that we run the node on the network, for example, so we can provide feedback on the infrastructure side. So yeah, it's just something to consider, and trying to also pick and choose potentially how you strategically go out and start pitching these types of investors. So your main objective here is to pique an investor's interest. So going into that and what that means, you need to know what an investor wants to see in your pitch deck. As an investor, you see many different pitch decks, and each investor has their own interests in general. So some will be interesting to some, whereas others will be interesting to others. But you need, really strong pitch decks are ones that really tell the story in the best way, honestly. And not only tell the story, but really a story that can resonate with not just one VC, but all of them, for example, and hopefully even people beyond VC that actually use your product. So in general, if I personally see a pitch deck and there's a problem there that has not been solved yet, or it's been solved in a way that might not be complete, or it might be a problem that no one's even discovered, which can be even cooler. This is very interesting because you know that this team and this founder knows something that other teams don't. So there's more of a case about why this team would be the best to execute on the vision, which is point number 3. And not only have they found a problem that is really sort of new or novel or hasn't been discovered or not solved in the best way, they also have the skills and experience where it makes sense, where it's like, okay, they might have some education in some area, or they might have some experience working somewhere else where they discovered the problem, and that's how they know that the problem is so big. Or they're very motivated by something in their life external to skills and experience about like why they're really passionate about building this, because you need a lot of passion. At the end of the day, as an investor, I'm looking at a project and I'm seeing, is this someone that's going to stick around for a year or 2 or 5 years or 10 years? Is this person's life work? And do they have enough skills and experience to actually execute on their vision, which is point number 2? And, can their life work be on this bold vision? That's a problem that hasn't been discovered yet. And then all these things together, coming together, can they do it basically? As an investor, you're always thinking, can they do it? Maybe you have doubts. And then, we'll get into this in a bit about like how you can sort of remove those doubts. But you want an investor for it to be a no-brainer. In fact, ideally as a project, even if you have a valuation that's slightly higher, it can sometimes make sense for an investor if the opportunity is so big and it's just so clear and obvious that there's an opportunity there that will allow you to raise more capital. It will allow you to have a high valuation in private markets as well the whole time. But to do this, going to points 4 and 5 now, you need a market that is large or untapped, or a market where people will pay to use your protocol or product. Because maybe the idea is great, the problem is there, the team can do it, but there's no market and no one's going to buy it. Which is a problem, of course, because you need to think about, point number 8 here, which is your business model. And you need a complete picture, like I keep saying, but really they will come together here where to have a market that is large, you can easily access users or, for example, Ethereum here is the biggest blockchain. So deploying on Ethereum probably means that you're going to have a lot of liquidity. But there are obvious disadvantages of deploying on Ethereum as well. But maybe in Archway, for example, just to take it back to some more relevant examples, is the market on Archway for your application or whatever you're building like large enough? In Cosmos, for example, you're lucky because you have the IBC. So maybe you can build on Archway and then access, liquidity or assets or whatever it is outside of Archway into your protocol on Archway. And that would be the market if it's not big enough on Archway. So you can be creative here, but you do need to have a coherent story on why this market is there and why people demand a product and how it goes into your business model. Because then if you don't have that, even though the problem might be cool and the vision is there, et cetera, VC or an investor might be confused as to how you're actually going to earn the revenues, and not only earn the revenues, but also accrue value back to the holders of the token or the equity at the end of the day, which is also something to bear in mind. A good business model, especially on tokens, goes a long way because there's a lot of doubt here about what is the best way of accruing value to a token. And I can tell you right now, as an investor, if you come up with a unique way to just accrue value, maybe the market isn't as big, but you have a unique way of accruing value that's more than other tokens that have bigger markets. So essentially you would accrue the similar value. Then this is very interesting. So even though you might not be complete across every point, you might be creative in some points. And this will then get, an investor interested again here, which is what you want. So differentiation as well is massive. So point number 5, and I want to outline this point and, sort of describe more about why it's important. So for a technology to be differentiated in crypto, what you have right now is it's not so hard to copy existing ideas and or copy direct code from just forking code on repositories. So as an investor, if I'm seeing something that is already been done on another network, which might have even a lot of traction, which is point number 6, I might not be 100% interested in this idea versus some others, because in any investor's sort of pipeline, they will have probably like 30 to 50 projects at a time that they're looking at. So out of the 30 to 50 projects, if they have like 10 to 20, which are just like the same types of ideas on Ethereum and bringing that to Archway, then that might not be so interesting for them. Whereas if you have an idea or technology that's differentiated, so, you have unsecured lending, for example, which is borrowing without putting, collateral up that matches the value that you're taking out. This problem hasn't really been solved yet. So it is differentiated if you can solve that. Plus the way you're building on Archway in general is cool because it's CosmWasm, of course. And, this CosmWasm ecosystem is still young. So I think what I'm sort of saying here is if you can come up with an idea that hasn't really been done before in ecosystems outside of Archway, this will be very valuable for an investor to see because they can't compare what you're building to another project in Ethereum, for example. So if some project comes to me on like where Yearn for Archway, I can sort of go on the Ethereum Yearn, whatever the market cap is of that, then I can actually sort of value that in Archway based on the traction and liquidity, et cetera, in Archway that's there right now. And maybe that isn't a massive opportunity versus the valuation that you're presenting in your sort of round. So I might not be so attracted to the opportunity there. So yeah, in general, differentiation is massive. Happy to answer questions there on like how you could differentiate as well. But really think about at the start or in any of these steps, how do you stand out and why are you differentiated and what you're doing new? So traction here can be big, especially in the early stages. And this is actually more important right now in this type of market. So anyone listening to this knows that the market right now is very tough. So not only do you need to be differentiated, but you should also have traction. So you should be able to prove to an investor that you have users either using it, or you have partnerships lined up with different ecosystems, or you have creators, if you're an NFT project, that are signed on to mint NFTs on your platform, or whatever it is. There needs to be some sort of clear trajectory on how you're going to get adoption as a project. And if you can show this with evidence and prove that you have some small growth, maybe you've got a grant from a big Cosmos sort of layer one, like Archway even, and you can prove that you've got this grant, that's already Archway sort of signing off and filtering themselves that what you're doing is a good project. So an investor will be interested to learn more at least. But yeah, traction is important in this type of market. Maybe in a bull market, it's more about growth. So it's more about selling the idea. But in a bear market, it's more about selling the traction you already have. And I'll get onto this in the next slide as well. So finally, you've got here a strong founders network. So as an investor, I sort of want to see, as founders, who's in your network and who can you recruit to make sure that your team grows and is as strong as possible to execute on your vision. So, where's the founder coming from? What country is it? Is this the new market? Who are they connected to? What ecosystems are they connected to in crypto? It's just connections never hurt, of course. So the more connected someone is, the more interesting it is, I believe, for an investor. And then finally here, you've got the go-to-market strategy. And this is important because, you have very limited resources. You have 3 or 4 people potentially before you start investing, or less. And you want to make sure you're prioritizing to maximize your value, to make sure that an investor understands what you're doing makes sense and you can actually execute on it, and you're prioritizing the right things that have the highest value with the least amount of effort. So this is somewhat about products. And then also with go-to-market, it should also be a bit about, your distribution and how you're actually going to get yourself out there to solve the cold start problem. And you need network effects, essentially, when you come out firing as a crypto project. I haven't seen many that don't achieve network effects for a year or two, then all of a sudden go crazy. It's quite often, if a project is going to be successful or not, because they're quite either steady from the start, where they have traction and they have some network effects and then they grow from that, or they just go crazy from the start and just keep growing there. So yeah, go to market and prioritization and product mindset can be very valuable here to think about. So just to briefly go over some bonus points here from what I just mentioned, especially in this type of market, which I want to really sort of emphasize. So you want to prove to an investor that you are a strong team that can do this. And not only should you be interesting for an investor, but also you should just be, you should have confidence yourself that you can speak to an investor and feel like you're going to pique their interest, like I said in the slide before. So then you can go into the presentation with the investor and show them, like, we have got this is who we're speaking to, this is who else is interested, etc. So a few of the sort of tips I might give here. First of all, if you have a grant from anyone, this is a good start, because you might not need to start with VC funding or investor funding. You can just start with a grant and get kickstarted. Is it from Archway? It could be from multiple different ecosystems, but grants can be a great acknowledgement of your work so far before fundraising. So that can also be a great idea to check that out and make sure you can at least apply and try and get by with what you can without giving away ownership. So number 2 would be references. This is probably more important at Series A stage and past the seed stage, whereas I would say my previous slide is definitely sort of presented in a way for more seed stage potentially. But Series A, if you want to continue, also sometimes in seed stage as well, you might want some references. But this is more about talking about whether it's a good idea or not. In Series A, it's potentially about the actual technology that's already been built, because you would have already hit some milestones. And so if you have references from tier ones that are like big VCs, big validators, big developers, big users even, you want as many references as possible. And then you can tell an investor, if you would like to learn more, you can speak with this investor or VC or validator or whoever it is, and they can learn a lot more about what an investor can learn a lot more through them about what you're doing. And they'll probably be influenced, especially if it's a party that they work with already, that they're partnered with or trust. And if they give, an investor a reference of what you're doing, this can really strengthen your case for an investment. And sometimes it can be enough to get you across the line, especially in Series A or beyond. So number 3 is materials. So any investor that has a call with you will want to learn more about what you're doing through documentation, frequently asked questions, because they'll go back internally and chat about what you're up to and some investor calls. Someone will be doing due diligence. If you can just provide as many clear materials as possible after you've already presented to an investor before an investor has committed, then you're going to go a long way, and you're going to really help them with their due diligence, and they can present coherently internally what you're doing, and also be a stronger chance of getting a yes from an investor committee internally to invest in your project. An alpha version doesn't hurt. So these last 4 points are more important, I would say, in a bear market again, which we're in right now. If you have an alpha version that someone can test and just like go in and click a few buttons to see maybe how it would work, even just an MVP, I would recommend this highly, because right now investors want to see that what you're building actually works, and they need more conviction essentially in what you're doing because there's less capital to go around. Also, it doesn't hurt to have a video demo. This can be brief, hopefully, like 30 seconds to a minute, about exactly how it works, what it does, and you can speak over it potentially. You can also link this with a deck. I think a short video demo that gets straight to the point is always well received. Revenues is massive, especially right now. If you can somehow scrap away and build something that's really differentiated and cool, as mentioned before, with revenues and early signs of users and traction, this would be, I would say, the best and easiest and most optimal path for you to start fundraising. So trying to think about, if you can, getting any revenues at all, and where this might come from, and sort of trying to receive this before fundraising. This will take you a long way, especially in this type of market. Maybe if the markets swing, it's not so important to focus on early stage, but now I would recommend it if you can. And the last point here is meeting in person. If an investor is unsure and then you meet them in person and your team is very appealing, and you are a good person in general, and the investor wants to work with you long term, it doesn't hurt to meet an investor in person. And the way I would do this is just maybe attending a conference, for example. So I wanted to drop in a slide here about negotiating terms with an investor as well. So again, going back to the VC game in general, it is a game, and the better you cover the previous slides I just talked about, the more likely it is that you'll be in a strong position to negotiate with the lead investor. Point number 1 here is what you would negotiate the most on would be on valuation. So maybe right now, the way investors come up with valuations is sort of random, depending on the investor and how they value you. Maybe they use comparables with other projects. Maybe they look at your revenues. Maybe they look at the potential growth. Maybe they look at the market and discount the market for what you're doing. There's many ways an investor could come up with it, but it's not standardized across the industry. So whatever lead investor you're speaking to, it should be clear on both ends, like why you're receiving a valuation is the main point. In this market, you can expect valuations to be lower than what they were 12 to 24 months ago as well. So that's just a given, because public markets are down 80% or so. So private markets might not be down as much, but that could definitely change in the next 6 to 12 months. So it's just being mindful that your valuation right now might be lower than what you expect, because valuations across the board are down. So, but you don't want it to be so far down that you feel it's unfair. So if you're earning 2 million revenues, 2 or 3 million revenues this year and next year, and it's growing, sort of quite fast, and then you get given a term sheet that is, 15 million valuation, and you're going to like sort of far outgrow that, maybe that's unfair, for example. So maybe you want to go up to 20 or 25 million, and then you can always chat with the lead investor about what they feel is fair. And at the end of the day, if you're in that much demand, hopefully you receive multiple term sheets, and you can pick and choose the valuation that best suits you and your needs. With point number 4 is the raise amount. So yeah, ideally you have many investors giving you term sheets, and you can choose the most value add, going back to point 1, like what fund would be the best for your needs. Then from that, you can negotiate even further on valuation and make sure that you feel it's a fair amount, which you can feel it's fairer if you're in demand in general. When you're also speaking to an investor, any investor, you should work out if they're a follow-on investor or a lead investor, and what sort of allocations both would get. It's pretty common for a lead investor to take like half of the raise amount. So if you're trying to raise like 2 million, you'd probably expect the lead investor to take like 1 million, about 50%. So working out what a follow-on investor would take after the lead investor. So maybe like the amount of follow-on investors you have as well. So maybe this same example, it's a 2 million round, you have 10 minutes left. You have 1 million left. You want to sort of work out, is this 10 by 100K tickets? And who are the other 10 investors that will follow on? So Chorus One here, for example, is a follow-on investor. So we want to be updated when you have a lead about who's investing, who's the lead investor, and how much allocation we can get. And this, again, is another negotiation thing about what would we accept versus what would they like us to have. And again, here it's all about communication, adjustments, fairness, just getting that sort of part of the game right. And then, on budgeting and value add expectations, if someone's leading, you feel like the valuation is fair, you should then work out exactly how they're going to help you and make sure that this lead investor is worth it and not going to just sort of purchase your token. And then if they're not happy, exit the token like very quickly. That's not ideal. And then not give you any help in between. You want an investor that wants to be aligned with you long term and has value adds where you are less strong. So maybe that's like research, for example, or maybe it's like infrastructure, like I mentioned before. There's plenty. Maybe it's like token economics where you don't know what the business model will look like, and you speak to someone like Delphi Digital, someone like that is really great with token economics, and they can help you out there. And then finally, on the budget, just negotiating, I guess, how you're going to use the capital. And in the term sheet as well, there might be some clauses on your budget and how much you pay staff and stuff like that. So it's just being mindful about, the more strong position you're in, the better terms you can get with the valuation, etc. But also how you use the capital that you receive and the flexibility you get with that. I just got like a one or two last slides here to just briefly go over. So after you've already spoken to an investor, you've gone through everything, got the bonus points, you've received a term sheet from a lead investor. After you've done all this, you want to wrap it up pretty quickly because shorter rounds are better. Then you can focus on building, and also you have momentum. So it's more likely that other VCs will be interested anyway. So you can ask for introductions to other investors from your lead investor. So, let's say one of the bigger funds I mentioned earlier, they probably know someone like Chorus One already, and they probably will introduce us to that project for an investment. Or you might have your own wish list that you can start reaching out to and say, we have a lead. Having a lead always makes it a lot easier for someone like Chorus One, which is a follow-on investor, to then seriously consider investing, because we know what the valuation is and we can come to our own decision about whether we invest or not. So number 2 is to update interested VCs, which is like important, what I mentioned before about, as Chorus One, we're not going to lead the investment. So we want to know if there is a lead, who you're talking to, what the valuation is, then how much time we have to actually make a decision, which is point number 3. So let's say you have a lead and you're like, we're going to wrap this up in 4 weeks and we have a lot of demand. You should definitely tell everyone you're speaking to about your expectations about when you close your round. Otherwise, someone like us, we're in the dark, we have no idea, we missed the round. And then it just creates a bad taste as well. Like, it just, manners never hurt in this industry. So if you can just even be polite to who you're speaking to, that goes a long way as well. You should also consider allocation per other investors outside of your lead investor. So, if you value one VC or investor over another, then you should probably prioritize them in your round and offer them more allocation. And then maybe there's one that invests small tickets, so they're happy with less allocation, so it makes sense to offer them less anyway. So it's just being strategic about the formation of your cap table, capital formation. Point number 5 is strategic investors that you might not have thought about. So like maybe it's like a market maker, you're building a decentralized exchange. You should think about investors that have capital that would make a big impact on what you're doing. So it might not just be VCs. It could also be node operators like us, market makers that invest as well, exchanges even. So it's good to think about anyone with capital that could be valuable in your round after receiving the lead. And then, after that, you should wrap it up and share the SAFs or safes, which are just safe, agreements for future tokens. Just, I guess here you want to make sure that when you share the SAFs and the safes, that you're following up. And if someone is dragging along and not sort of reviewing or signing, then maybe give them a few reminders, but then just if they don't sign after 4 or 5 reminders, then maybe you should expect that they might not sign, and then try and think about how you might recover that with another VC to take that allocation. So what you, at the end of the day, at this stage, you want to make sure that the capital is in the bank. So share the SAFs, remind them, make sure they're signing quickly, share the payment details. It's quite common to receive, an address on Ethereum, for example, which is like USDC or USDT. Share the address, make sure that the signer has then proved that they've sent the funds, then lock it up wherever you're locking it up, in some bank of your choice, or maybe it's on chain or however you're doing it. And then after you've received all allocation signatures, shared all the SAFs, received all the capital, inform the other VCs that might have skipped you around, just to let them know, even if you're not having conversations with them anymore, that it's closed and you might open another one up in the future, and you'll share more details when that happens. So just keeping everyone in the loop is important. So yeah, how to stand up from the crowd. So just don't forget you're competing with multiple projects in a VC's pipeline. So everything I've explained in this presentation would be good to think about how you can differentiate not only your project, but also yourself individually and as a team. You want to strategically choose what VCs you put more time into. If you have a lead, then you should be spending the most time speaking with this lead. Or if you have a lead that's not responding, then you should spend less time with them and focus on other leads. So it's just being strategic at the end of the day. You want to collaborate with VCs and not just ask for fundraising potentially. So maybe you speak with an investor that might not invest funds, but then you have an idea with your tech that is cool that this investor might have knowledge on. You can just share the information, and even maybe if they don't invest in you, they're probably happy to help you out and even just talk about what you're doing and see if they have any ideas. So this is a great way of building a relationship. And point 4 here is you want to continue the relationship with the VC, even if you don't get funding. So maybe you're in seed round and you go on a Series A at some point in the future. So at that point, you just want to make sure that you have good relationships with as many investors as possible, because this puts you in the best position to raise in the future. So you don't want to turn off any VCs from the start, also because they talk to each other. So it's not a good sign if, a few of them already are not happy with what, how you've treated them or behaved. And yeah, number 5, I think a great one to stand out actually is a frequently asked questions page for VCs to refer to. This is great with our own due diligence. So not just a deck, but also some materials, maybe like a 1 or 2 pager or even a bit more, on just what questions do you get asked all the time by investors, and how can you respond to all of these in just this 1 or 2 pager, so you don't have to continue repeating yourself, and you can actually speed up the fundraising process, and also an investor finds it valuable. And finally, a strong brand and story here can go a long way. So if you have a story, you're the right people to build the product, it's differentiated, you're in it for the right reasons, you're motivated to build this, something's really driving you, and your brand is strong, you have a good name, your team stands for something, if it means something to you and there's a big purpose behind it, then a VC is going to find this attractive and appealing to invest in your project. So finally, just a tip to enjoy the process. The whole fundraising process is challenging but rewarding. And yeah, thank you everyone for your time. You can find me on Twitter at @0xave. I know we're a few minutes over time, so thank you for everyone's time for tuning into that. And feel free to reach out to us at Chorus. We invest a lot, especially in the Cosmos ecosystem. So if you're coming from Archway, we'll be interested to take a look at your project. And yeah, you can find us on the socials there on the bottom right corner. So thanks again for your time.
Perfect. Thanks, Xavier. So thanks to everyone for joining us today. And obviously a very special thank you to Xavier from Chorus One for sharing this really valuable insight into how teams should be pitching to investors. I mean, it's something that obviously teams don't usually get knowledge on and get to learn about prior to pitching. So it's something it's actually super valuable for these early stage teams that are participating in hackathons, not only the Archway one, but also other ones as well. So thanks for that. And as mentioned, the Archway Hackathon is currently underway on our platform, DoraHacks.io, and ends in 1 month's time, about 31 days. So there is still plenty of time to get your submissions in. And there's some great prizes to be won. And also it's a fantastic opportunity to join the growing Archway community. On DoraHacks, we do have a range of sessions like today's coming up in the future. And we also have hosted previous sessions like this one. So they're available for you to watch on our platforms. So please make sure that you follow us on YouTube and Binance Lives. So thanks again for joining us today. And thanks, Dave, for your presentation.
Thanks, George. Thanks, everyone.
Thank you.